Before we start this video, do like and subscribe to our channel and not miss on any updates.
Good morning once again. Today we'll start with Accounting Standard 19. Okay, important but is not tested frequently. But again, some of the questions which are tested from this standard can be solved if you understand the right approach to solve the question. That is the first thing. Second thing is, a lot of students unnecessarily get scared by the depth of the standard. Okay, so my suggestion to you all is, don't get scared by the depth of the standard. Think logically as to how we can approach some specific types of questions. Remember the disclosures as much as you can. That will take care of this standard, right? So when we talk about Accounting Standard 19, which deals with leases, Accounting Standard 19 which deals with leases, in common language, generally we refer to this as rent. Okay, if at all there is a rental kind of an agreement, of course there are some conditions to be satisfied, but normally you can think of it as there is someone who is an owner, owner of, let us say, a property. The property can be building, the property can be machinery, the property can be a lot of items other than those which are specifically excluded by the standard, right? So there is an owner of a property. Let us say the owner owns a particular building or a flat or an apartment. Then there is a user of this building. So there is a owner, there is a user. The owner allows the user to use the property. The owner allows the user to use the property, to get benefit from the property, and in return the user has to pay to the owner something called as rent, or in the technical part of the standard we will refer it to as lease, rentals, or lease payment. So the owner allows the user to use a property, in return for which the user has to pay rent to the owner. Okay, this is a simple way to understand what is a lease. Now, the one who owns the property is called the lessor, and the one who uses the property or who takes the property on lease is called a lessee. So we have one party lessor, another party lessee. As far as the examination is concerned, you can be asked about the treatment in the books of the lessor or in the books of the lessee. Either ways it is possible. Now, one key thing that you need to understand here is, the owner has not yet sold the property to the user, or the lessor has not yet sold the property to the lessee. But in some instances, like in case of a finance lease, we will assume as if the lessor has sold the property to the lessee and accordingly do the accounting. This is a broad background of how we will do the lease accounting. Another small thing that you need to understand is, why was this standard implemented? Why do we need a standard on lease? The reason is, generally companies, if they want, for example, if I have to buy a property, let us say I have to buy a property, what I can do is, I can take a loan from the bank and I can make the purchase, correct? I can take a loan from the bank and I can make the purchase. Now, if you see my balance sheet, you will see building on the asset side and loan on the liability side. Typically, if I want to purchase a property, I will do this. But say for example, I don't want to show this as a loan in the balance sheet, because the moment you show debt, it is perceived to be negative by the investor. So what I do is, I go to someone and say, I will take property, that is building, I will take it on lease for 30 years, assuming 30 years is the life of the project or property. I will take it on lease for 30 years. For 30 years, I will make the payment. I will not cancel the lease. So what I'm trying to do, I'm trying to take something on rent for 30 years, but I'm committing to the rental payments. I will not be able to cancel the rental payments. And for the entire 30-year period, I will be enjoying the property. That is the arrangement. Now, in this scenario, before the standard was introduced, what used to happen is, because I have taken it on rent, I would never show any building or loan in the balance sheet. This gave an incorrect picture to the users of the financial statement. Of course, I would do some disclosure somewhere, but The essence of this transaction was that I had enjoyed the ownership benefits. I have taken a commitment for 30 years, like I have done in the case of loan, but I am not showing this. I am not showing this in the balance sheet. That is where the standard setters realize that this is not the right thing. So what you have to do is, there is a category called finance lease, and in case of a finance lease, you have to show an asset and a liability in the balance sheet. Okay, so that is the background of the standard, not relevant from your examination point of view, but for you to understand. Right now, we said there is one party lessor, there is another party lessee. What does the lessee make payments? The lessee makes something called as lease payments. The lessee makes something called as lease payments to the lessor. Right now, there are a few terms we need to understand. Of course, we'll look at the definition as per the text, but we need to understand before we move ahead in the chapter. Now, when I make the payments, say for example, I have taken a vehicle on lease. So I have taken a car on lease. Okay, I have taken a car on lease. There is a lessor, there is a lessee. I have taken a vehicle or a car on lease. The term is 5 years. The term is how much? 5 years. When I say the term is 5 years, I am referring to the non-cancellable period. Always remember, the lease term is the non-cancellable period. The lease term is the non-cancellable period. So I have taken it for a term of 5 years, which is a non-cancellable period. Then what I have agreed is, I will pay rupees 1 lakh per year. I will pay rupees 1 lakh per year. This is called fixed lease payment. This is called fixed lease payment that I am making to the lessor. Okay, so the lessee makes payment of 1 lakh per year, which is the fixed lease payment. Apart from this, what I have also done is, I have said that at the end of 5 years, I will arrange a buyer to buy the car at 2 lakhs. At how much? 2 lakhs. What I am saying, I will get someone to buy the car at 2 lakhs, or I am giving a commitment that if you cannot sell the car to somebody else, either I will get a buyer or I myself will buy the car at 2 lakhs. Now, this is not a confirmed thing, or this is not a mandatory thing that I will buy. I am telling to the lessor, or the owner that I will use the car for 5 years. At the end of 5 years, if you want to go out and sell to someone, please go ahead and sell. If you don't find any seller, I am ready to take it for 2 lakhs, or I will get a buyer for 2 lakhs. This is called residual value guarantee. It is not mandatory that I will buy. It is not mandatory that I will buy. What I am simply saying is, you sell it to somebody else. If you don't get a buyer, or if you don't get the value that you want, I will get a buyer for 2 lakhs, or I will buy for 2 lakhs. I am guaranteeing that amount. But is it mandatory for me to buy? No. Is it a choice that I can buy? No. Only if somebody doesn't get, then I will get the option to buy. This is called residual value guarantee. This is just an example. Other forms of residual value guarantee could be, I'll make a lump sum payment at the end of a period. That is what I'm guaranteeing if the lessor does not get something from outside. Okay, that is the first thing. So let us say if I take a building on lease, I'll say I'm guaranteeing 50,000 towards your residual value of the furniture. That is my guarantee. But the lessor says, I am expecting, or I expect 2,50,000 at end of 5 years. This 2,50,000 is the total residual value. It is the total residual value. What is the guaranteed portion? 2 lakhs. So what is the unguaranteed portion? Unguaranteed portion or unguaranteed residual value is 2,50,000 minus 2 lakhs, that comes out to 50,000. That comes out to 50,000. So we have understood two terms: residual value, the total value that the lessor expects that he will get at the end of the lease term. Residual value guarantee is the guarantee given by the lessee or on someone on behalf of the lessee. Unguaranteed residual value is something which is not guaranteed by anyone. So you have total residual value, out of which you have guaranteed 2 lakhs and unguaranteed 50,000. Unguaranteed residual value is relevant only for lessor. Lessee is not bothered about unguaranteed residual value. Okay, I hope it is clear so far. Then this is one scenario. Another scenario can be lessor, or I'll not put this way. Lessee has an option to buy the car at 50,000 at end of 5 years. Now here what I am saying is lessee has an option. Now what is the value that we are expecting? The expected value is 2,50,000. If somebody tells me that there is an asset which is worth 2,50,000 and you can buy it at 50,000, will I exercise? Yes. So this is called an option to buy which the lessee is likely to exercise. Okay. Now this payment, whatever payment we make 50,000, this is relevant for lease calculation. This is relevant for lease calculation. Now, if there is an option to buy, generally you will not have residual value guarantee. But if it is a larger asset, for some part there may be an option to buy. For some part there may be a residual value. That is also possible. Okay. Then there is a third scenario where lessee has agreed to buy at, let us say, 1 lakh. Now, when I say agreed to buy, it is a mandatory transaction. So the three differences that you need to understand is, if I say that the lessee has guaranteed, the lessee has guaranteed some amount, that is called guaranteed residual value. Then there is an option to buy. That is optional at the in the hands of lessee. If the lessee wants, the lessee can buy. If the lessee does not want, the lessee need not buy. The third one is agreed. This is mandatory. And you have to compulsorily transfer 1 lakh and buy the asset. Okay. So these are the few terms which you need to be aware of. Is there any doubt in unguaranteed residual value or option to purchase or mandatory purchase? Do you have any doubt? Please, if yes, please let me know. Otherwise, I will continue with the remaining part. Clear, everyone? Now, our objective in the examination should be to correctly identify what is UGRV, what is residual value, what is the option to purchase, what is the mandatory payment option. Okay. Now, we have discussed few things. Two more terms we will discuss, and then we will go into the definition as per the text and see whether we understand or not. Okay. Now, we say MLP, which is minimum lease payment. Now, minimum lease payment, you can understand it as something which is a mandatory payment from the lessee to the lessor. So, minimum lease payment for the lessee would be whatever we have as fixed lease payment. Then, if at all there is any residual value guaranteed, or we call it guaranteed residual value by lessee or on behalf of the lessee, then if there is an option to purchase that part, then if there is a purchase agreement. See, the difference between these two is, when I say option to purchase, I have a choice. But if I have an agreement to purchase, I don't have a choice. Very simple. Okay. So these all are included in the lease payments. There could be other aspects also to be included, as and when we handle the questions, we'll see it. But if you remember this, it is enough. When it comes to lessor, the lease payment or the minimum lease payment is minimum lease payment of lessee, minimum lease payment of lessee plus guaranteed residual value by any third party. When I say guaranteed residual value by a third party, it basically means other than the lessee, someone has given me a guarantee. Now think of it. As far as the lessor is concerned, he will get whatever he can get from the lessee, plus if at all some third party has guaranteed, that also we will consider. Okay. Now that is called the lease payment or minimum lease payment from the point of view of the lessor. Then we have a term called gross investment in lease. Gross investment in lease is sum of all lease payments from the point of view of the lessor plus unguaranteed residual value. Gross investment in lease is sum of all lease payments plus unguaranteed residual value. Right? Now, in the examination, sometimes they'll ask, what is the gross investment in lease? Then what is the net investment in lease? What is the unearned finance income? Now, what is net investment in lease? Net investment in lease is present value of all lease payment plus unguaranteed residual value. Present value of all lease payments plus unguaranteed residual value. That is the net investment in lease. Then unearned finance income is equal to gross investment in lease minus net investment in lease. We'll do it once again with the text so that it is absolutely clear. Right? Now, when I say present value, I need to know what is the discounting rate. I need to know what is the discounting rate. Now, as far as discounting rates are concerned, the standard says that discounting rate is the interest rate implicit in the lease. Interest rate implicit in the lease. So what is this interest rate implicit in the lease? Basically the IRR of lease of lessor. Because what the lessor has done, please understand, if this I consider as a timeline, on year 0 he has made some investment and over a period of time he will get lease payments. Okay, the lease payments, whatever is the lease payments that he is expecting to get, plus the residual values. This lease payment, if I discount it and bring it back to year 0, at what rate will the NPV will be equal to 0, which is nothing but my IRR, which is nothing but the implicit rate in the lease, interest rate implicit in the lease. This is the rate at which we will discount. So lessor will always use the implicit rate of lease. But when it comes to lessee, if the lessee knows the implicit rate in the lease, lessee will use that rate. If the lessee does not know the implicit rate in the lease, then you will use the incremental borrowing cost. This is some conceptual understanding or the broad framework of terms which are relevant for you to solve the questions. It is important that we identify these terminologies correctly. Once you have done identification, calculation part and passing the journal entries is very, very simple. It is not at all a challenge, right? With this understanding, let us see. Okay, so some formatting issue, but anyways, right? So, when it comes to Accounting Standard 19, as far as the scope is concerned, some items are excluded. What are the items excluded? Lease agreements to explore for or use of natural resources such as oil, gas, timber, metals and other metal rights. So if at all you are taking a mining contract or if at all you are exploring natural resources, oil resources and all of that, that is excluded from AS 19. Licensing agreement for items such as motion picture films, video recordings, plays, manuscripts, patents, copyrights, etc. So if I give the license of, let us say I am giving license to theaters to run my classes, okay, if it's just for example, those leases or those licensing arrangements, when I am giving the other party right to use my videos, that is excluded. Lease agreements to use land. So if at all there is a lease agreement to use land, that is also excluded from the scope of this standard, right? These are the exclusions you have to remember because institute has got into the habit of testing some of these as MCQs, right? Now, we have understood what is the meaning of lease. A lease is an agreement. There has to be an agreement whereby lessor is the one who gives the asset on lease, conveys to the lessee, who takes the asset on lease in return for a payment or series of payments, that is the lease rent, the right to use an asset for an agreed period of time. So what is happening? There is a lessor. The lessor gives the asset to the lessee for using for a period of time, and there is a right to use an asset. Right to use an asset means what? Once I have taken the asset on lease, it is my choice how I want to use the asset. If I want to use, I will use. If I don't want, I will not use. It is purely on my choice. Okay, and there has to be there is an agreed period of time. So the term will be given to you in the question. The lease rentals either will be given to you in the question or you have to derive it. Right? Then inception of lease. Inception of the lease is the earlier of date of the agreement or date of commitment to the principal provisions. So for example, I want to take a office space on rent. I have gone to the owner, I have discussed and we have agreed the principal terms of the lease. So let us say we agreed everything on 1st of April of 25, but the lease, the agreement was entered on 1st of May of 25. Now, if I have already agreed everything here, this becomes the inception of the lease. Or if I have already signed the agreement, then this becomes the inception. This becomes the inception of the lease. So basically, I will take on 1st of April of 25, where I have agreed all the provisions. That period is called the inception. That period is called the inception of the lease. Okay. Now, lease term, very important. Lease term is the non-cancelable period for which the lessee has agreed to take on lease the asset together with any further period for which the lessee has an option to continue the lease of the asset with or without any further payment. Now here, this we need to understand slightly better. Let us say we have agreed that the property will be given to us, or we will take over the property from 1st of April of 25, and for 3 years lessee cannot cancel the lease. So that is what is called the lease term. Okay, so the non-cancelable period is what is called the lease term. Then if there is an option with lessee to extend by 1 more year. Now, when I say I have an option to extend by 1 more year, the other party cannot refuse. Please understand this. If I say I have an option to extend the lease by 1 more year, the lessor cannot refuse. The lessor cannot say no, because I have the option. If I have the option to extend the lease and the lessor cannot deny, then in that case, this 1 year also gets added to the lease term. Okay. Now, as far as the exams are concerned, at your level, they will not get into cancelable, non-cancelable in detail. They will directly give you, this is the term of the lease. And you have to assume that the lease term, whatever is given in the question, is non-cancelable unless the question says that it is a cancelable part. Cancelable means I can give 1 month notice and I can vacate the premise. That is a cancelable lease. Okay. So, lease term is the non-cancelable period for which the lessee has agreed to take on lease the asset together with any further periods for which the lessee has option to continue the lease with or without the payment. So this is the lease term. So you have understood lease, inception and lease term. Then minimum lease payment. Minimum lease payments are the payments over the lease term that the lessee is or can be required to make. So lessee has to make, excluding contingent rent and cost for services and taxes to be paid by and reimbursed to the lessor. So basically what it means is, whatever we are paying for the asset, only that he will consider in the lease payment. If there is any contingent rent, now contingent rent means rent dependent on a future event. For example, the rent could be 10% of sales. You have to pay 10% of sales. Now this 10% of sales, I don't know. If there are no sales, I don't need to pay. So such kind of contingent payments is called is excluded from the lease payment. When we say excluded from the lease payment, what it means is, for AS19 purpose, we will not consider. So if I have to pay 10% on sales, I will directly charge it to P&L. Okay. Then cost for services and taxes to be paid and reimbursed to the lessor. So basically, if I take a building on rent and if I have to pay for maintenance services, that is not a part of my lease payment. Or if I have to pay, let us say, property tax on behalf of the lessor, that is also not a part of the lease arrangement. That is also not a part of lease payment. So any service or taxes that is to be paid or it is to be reimbursed to the lessor is not a part of the lease payment. Lease payment only covers lease payment towards right of using the asset. Okay. So the payments that the lessee is required to pay, together with, in case of lessee, any residual value guaranteed by the lessee, and in case of lessor, residual value guaranteed by the lessee or a third party. So if we come back to our discussion, fixed lease payment, residual value guaranteed, any of these payment guaranteed, and for lessor, whatever the lessee has guaranteed plus guaranteed residual value by any third party. So minimum lease payment includes lease payment, GRV, purchase exercising options payment. So purchase or exercising option payment, that is also included. This is what is excluded. Okay. Now as far as the lessee is concerned, you will only talk about lessee's guarantee. As far as lessor is concerned, you will consider both the lessee and the independent third party. Any question on this so far? Okay, so residual value we understand, economic life we anyways understand. Guaranteed residual value for lessee is what has been guaranteed by the lessee or on behalf of the lessee. For the lessor, which is guaranteed by or on behalf of the lessee or by an independent third party. Unguaranteed residual value is the amount by which the residual value exceeds the guaranteed residual value. So UGRV is equal to RV minus GRV. Gross investment lease is the aggregate of minimum lease payment under a finance lease from the standpoint of the lessor and any unguaranteed residual value. This also we have discussed. Unearned finance income is difference between the gross investment and present value of your gross investment in lease. That is what you can understand. Interest rate implicit in the lease is the discount rate that at the inception of the lease causes the present value of MLP under a finance lease and any unguaranteed residual value to be equal to the fair value of the leased asset. Implicit rate is always calculated from the point of view of the lessor. Okay. Now, having discussed this, let us now move on to the discussion on types of leases, right? Now, types of leases, basically there is a finance lease and there is an operating lease. For finance lease, we have 5 conditions. We have 5 conditions. Now, what are those 5 conditions? Conditions for finance lease. The first condition, it is, I'll give it to you in a way where you can remember it easily. Okay. First condition, of course, the sequence is given differently in the book and also in the text. But first condition is if lessee has option to purchase and it is reasonably certain to exercise. Now, what does this mean? Say, for example, I have taken a car on rent, a car on lease. Okay. Once I've taken a car on lease, at the end of 5 years, period, the residual value expected, for example, is 2 lakhs. I have an option to buy at 50,000. So if I have an option to buy at 50,000, do you think I will exercise the option or not? Of course I will exercise, because something for 2 lakhs somebody is giving me at 50,000. So in that case, I have an option to purchase and I am reasonably certain to exercise the option. If this condition is satisfied, it is called a finance lease. Now, why is it called a finance lease? It is called a finance lease because of two things. One, the risk and rewards of ownership is transferred to the lessee. Sir, why is it transferred? I have used the asset for 5 years. After 5 years also, I will be using the asset. So the entire risk and rewards of the ownership of the asset ultimately has been transferred to me. That is the first thing. Second, the lessor is more acting like a financer. The lessor is not acting as someone who is interested in rent, because he has financed the asset, he has purchased the asset, and he has given the asset to me. He is not interested in continuously using that asset in the future, or he is not interested in giving it to rent on rent for somebody else and make more money. He is more interested in his finance income that he wants to earn. Okay, so that is where we say it is a finance lease. Second condition related to this is if there is a purchase agreement. In the first case we said the lessor will the lessee has an option to buy. In the second case, what we are saying is the lessee will purchase. There is a purchase agreement. The lessee will purchase the asset. In this case also, the risk and rewards get transferred, and hence it is called a finance lease. So two conditions done. Third condition, the present value of lease payment is almost, or you can say substantially, equal to the fair value of asset. Now think of it. I have taken a car on lease. The lease payment, the present value of the lease payment is 4,90,000. The fair value of car today is 5 lakhs. Now see, if I have almost paid the entire fair value of the car over the lease period, then would I have not gone out and purchased the asset itself, right? So I am looking at it from a owner's point of view, right? Because see, the difference is only 10,000. So if I substantially pay the fair value of the asset in present value terms, that also becomes a finance lease. The threshold criteria is 90%. So if the fair value is 5 lakhs and if I do 90% of this, if the present value is 4,50,000 or more than that, then also it is called a finance lease. Then lease term covers substantial period of economic life. So car has a useful life of 5 years. I am using it for 4 years. So again here, substantial part of benefits is taken by me and it will be called a finance lease. Here we use a threshold condition of 75%. And lastly, it is a customized asset. Now what is this customized asset? I have taken an asset which is customized for me. The lessor cannot use it for any other purpose. So for example, if I have taken a centralized air conditioning as per my office requirement, the lessor, if they want, they can remove the machinery and they can take it away, but they will not have great use out of that. Okay, so the asset has been customized as per my requirement. Only I can use the asset. The lessor does not have any other use. So in a nutshell, the lessor has built the asset for me. I will enjoy the benefit out of the asset. The risk and rewards are assumed to have been transferred, and hence it is also called a finance lease. Okay, so the conditions of a finance lease: when a lease transfers substantially all the risk and rewards incidental to ownership of an asset, that is called a finance lease. Transfer of the legal title is not relevant. Okay, now the indicators of finance lease: transfer of ownership at the end of the lease term, option to purchase leased asset at a bargain. Bargain means at a very low price which the lessee is likely to exercise. Lease term covers major part of economic life. Here we will take 75%. Present value of minimum lease payment is equal to or substantially equal to the fair value of the asset. This we will call it at 90%. Leased asset of specialized nature cannot be used without major modification by the lessor. So if these conditions, if any of these conditions are satisfied, then it is called a finance lease. If none of these conditions are satisfied, then it is called an operating lease. lease classification is done at the inception of the lease. Okay. Now, after having understood the classification of lease between finance lease and operating lease, our large part of discussion or a large part of focus will be accounting in the books of the lessee, and then we'll come to the accounting in the books of the lessor. In the books of the lessor also it is pretty similar, but more likely questions will come from finance lease in the books of lessee. So in the books of lessee, at the inception of the lease, lessee should record the asset at a value which is lower of fair value of the leased asset or present value of the minimum lease payment. So what you have to understand is, you have the lessor, you have the lessee. If it is a finance lease, you can think of it that in substance, we will apply the concept of substance over legal form. So in substance, the lessor has sold. See, actually it has not sold, but lessor has actually in substance, lessor has sold the asset to the lessee. So then now lessor becomes seller, lessee becomes buyer. The lessor becomes seller, lessee becomes buyer. Now, has the lessee paid something immediately to the lessor? The lessee has not paid something. So in that case, you can also say that lessee will pay something in the future, and it is something like a loan which is taken by the lessee, because lessee has not paid anything upfront. So lessee becomes the borrower and the lessor becomes the lender. So lessor is acting like as if I have sold the asset, but because I have not received the money, I am treating myself as the lender. And on the other hand, the lessee will say I am the buyer and the borrower. Now lessee will account for it, the asset under the finance lease, at a value of lower of fair value or present value of minimum lease payment, in lower of these two items. Okay. Now in most of the cases, the fair value and present value of minimum lease payment, as far as the examinations are concerned, will be same. Okay, because the rate is determined using the fair value, so ultimately you will get the same amount, right? Very unlikely case that the fair value is lower than the present value of minimum lease payment. Okay, so this is the one. So what the lessee will do is, lessee will take all the minimum lease payment, they will calculate the present value. This present value, the lessee will say there is an asset debit to liability. At what value? At the lower of these two values. Okay. Now, to calculate the present value, we need the discount rate, which will either be the implicit rate. If implicit rate is not available, then we will take incremental borrowing rate. Don't learn this as lower of 2 or higher of 2. If implicit rate is there, use the implicit rate. If implicit rate is not there, the second preference is incremental borrowing. Okay. Now, with this understanding, what we'll do is, we'll have a look at a question itself so that we are able to solve it easily and understand it easily. Okay. An enterprise, the lessee, acquires a machinery on lease from a leasing company, the lessor, on January 1st of 2016. The lease term covers the entire economic life of the machinery. So if it covers the entire economic life, one of the condition is satisfied, so it becomes a finance lease. The fair value of the machinery on 1st of January of 16 is 2,35,500. So 235,500. The lease agreement requires the lessee to pay an amount of 1 lakh per year beginning December 31st, 2016. So now, here please understand, the commencement or inception is January 1st, payment is happening on December 31st. So these are called end of period payments. These are called end of period payments. Now if you have end of period payments, when you discount, so whatever is paid at end of year 1, 2 and 3, the present value factor you will consider 1 divided by, say for example, 1.1 to the power of 1 1 divided by 1.1 to the power of 2, 1 divided by 1.1 to the power of 3. Like this we will discount. Okay. If it is paid at beginning of the year, then first payment we will assume is made at 0. So the discounting factor is not applicable. Okay. The lessee has guaranteed a residual value of 17,000 on December 31st, 2018. So see this 2016, 2017, 2018. Here they have guaranteed. Who has guaranteed? Lessee 17,000. The lessee uses SLM method for the depreciation. Okay. Right now, here first, so we will use information to compute the IRR. But generally these days in the questions they give what is the implicit rate of return. Okay, if it is not given, then we have to calculate, right? So because here rate is not given, we have to calculate the rate. Now how do we calculate the rate? What you have to do is take a timeline 2016, 2017, 2018, 2019. 19 is not there, no? So we have only 3. Okay. So 2016, this is 0 beginning. So I think rather write the date so that it is easy for you to understand. This is 1st of January of 16. This is 31st of December of 16. This is 31st of December of 17. And this is 31st of December of 18. Okay. Now on 1st of January, think of it that a machine with a fair value 235 means the lessor has invested 2,35,500 in the machinery. So as far as the lessor is concerned, there is an outflow of 2,35,500. Then what is the inflow? 1 lakh here, 1 lakh here, 1 lakh here, plus 17,000 here. Because on 31st December of 18, a residual value guarantee of 17,000 is also there. So what we need to do is, we need to find a rate which will equal these payments when discounted to 2,35,500. Now tell me one thing, how many of you are not comfortable with calculation of IRR in the exam, in financial management, whatever you have learned, or even in AS19 if you have learned already? How many of you face difficulty in calculating IRR, or are you comfortable to calculate IRR? Yes, no, maybe you have to tell me, because accordingly I will, do the working. Sorry?
You will give a range of numbers in the question, right, for the present value factors.
Yeah, these days they have started giving.
Okay, yeah, then it's fine, I guess.
Others? Comfortable, right? Because see, the idea is to teach you how to handle the questions. If you already know how to calculate IRR, I'll not spend too much of time. So what you have to do is, I'll just give you a quick, thing. Right now, they have not given any rate here. They have not given any rate here. So generally these days they have started giving present value factors and present value annuity factors. Okay, using that you can do the calculation. Now, first you will calculate at one rate. So let us see, here you have taken 13% as the rate. And when we calculated the NPV, it came to 12,397. Okay. Then, I think here something is missed or something is out of the thing. Just a moment. One divided by 1.1. 0.8. This is not 13%. This is 13%. This is 17%. Okay. So you'll use the calculator. 1 divided. You'll use the calculator. You will do 1 divided by 1.1. First time when you get 1.13, first, second, third, and this is also the third year, right? So you calculate the present value factors, multiply with the payments, you will get the present value. So present value at 13% comes to 12,397, and because it is positive and we have to make it negative, we will increase the discount rate. The higher the discount rate, lower is the present value. So from 13% we have taken it to 17%, and when we do at 17%, we got minus 3,927. So from 12,397 positive, it has become negative 3,927. So how much is the gap here? The gap is 12,397 plus 3,927, that is 16,324. So for 16,324, we had to move it by 4%. How much do we need to move it by? We need to move it by either 12,397 to reduce, or 12,397 to increase. This is at 13%, this is at 17%. So either we take 13% and reduce 12,397, that is increase the rate by that proportion, or take 17% and reduce. So for 16,324, if it is 4%, for 12,397, how much is the number? We can do a cross multiplication. So the number will be 12,397 multiplied by 4% divided by 16,324. Okay, so that will be equal to 12,397 into 4% divided by 16,324, that is 0.03. 0.0303, that is approximately equal to 3%. So if you take 13%, you have to add 3% and we get 16% as a number. Very unlikely that in the examination they will not give you the rate. Okay. Now once you have decided the rate, what do we need to do? We need to calculate the present value of minimum lease payment. Now, since one trick for the examination, since fair value is equal to present value of MLP, okay, you don't need to calculate again present value, because even if you calculate, you will get what? You will get 2,35,500. If this number is not given, what we will see in the subsequent question, then we have to do the calculation. Okay, so you will take the value of 2,35,500, which is nothing but the fair value. The fair value is equal to the present value in this case. In other cases, we may have to do the calculation. Now, at the inception, what you will do is you will record an asset of 2,35,500 and you will record a liability of 2,35,500. For this liability, you will prepare something called as an interest schedule. You will compute something as an interest schedule. How to compute the interest schedule? You will write the years, liability outstanding or opening balance, then interest, closing balance, payment. Okay, so another way what you can do is year, opening balance, interest, payment, closing balance. Year, opening balance, interest, payment, closing balance. So year 2016, opening balance is 2,35,500. Interest at 16%. So 235,500 into 16%, we get 37,680. Payment is 1 lakh. Closing balance is opening balance plus interest minus payment. So opening balance 235 plus interest 37,680 minus payment, the closing balance comes to 173,180. The closing balance comes to 173,180. Like this, you will do for all the 3 years, such that the closing balance here should be 17,000 or 17,031, rounding of reference. Okay. Second thing is, what you need to understand is, my opening liability minus closing liability is principal. That is 235,500 minus 173,180. So 235,500 minus 173,180 is the principal payment 62,320. 62,320, and this is the closing balance. Like this, you will prepare for 3 years. Apart from that, on the asset, on straight line value basis, you will calculate depreciation. You will calculate depreciation. How to calculate depreciation? Depreciable value is your asset value minus guaranteed residual value. So why are we taking only guaranteed residual value? Because that is what we will get, or that is what we are expecting that we will get at the end. That is our payment towards the end. That divided by 3, you get 72,833. Okay. So at that value, you will depreciate the asset every year. What are the entries? First entry, fixed asset to lessor, that is your asset to liability, 235. Then depreciation to provision for depreciation or fixed asset. You can use either of the two. That is 72,833. Then interest to lessor every year, 37680 for the first year. Then for the second year, 27709, third year, 16142. And these numbers will be transferred to P&L to interest and depreciation. In the P&L, you will have depreciation and finance charges. In the balance sheet, you have the lessor, opening balance minus whatever you have paid, closing balance, fixed asset minus depreciation, closing balance. First year. Same set of entries will be repeated in the second year, and same set of entries will be repeated in the third year. At the end of the third year, you will have closing balance of fixed asset as 17,000. So why do we show it? Because that is my expectation of the residual value. Okay. And the liability account will be closed actually. So you will have 37. This you will write off against this itself. So you will have in the interest column at the end here, because it is 31, you will do minus 31 here, which is the balancing figure here. Don't forget to do this balancing figure at the end of the third year. Okay. Set of entries, quick revision. Capitalization entry, fixed asset to lessor. Depreciation entry, interest entry, transfer to P&L, and payment also, lessor to bank account. Okay. Any questions in this set of entries and also the calculation part? Now, will we get such a long question in the examination? We will not get. Okay, we'll get either prepare the table, first year entry, last year entry, something like that. You will not get a very long set of questions to be done in the examination, right? Now, that is as far as the lessee's books are concerned. So let us again do a recap, and I'll tell you, if you have calculated the amounts correctly, this is a pure high scoring concept. Okay, don't get scared the moment you see a lease question. Oh, it's a lease questions, I should not, it's very difficult, I'll not be able to do. That should not be the approach. These kind of simple questions actually help you score good marks. Okay. So in the books of lessee, at the inception, we should record the asset at value which is lower of fair value and present value of minimum lease payment. Discount rate is IRI or incremental borrowing rate if the IRI is not known. Okay, so if both are known, you will always take implicit rate in the lease. Lease payments will be apportioned between finance charges and principal. Finance charges will be allocated to a period during the lease term to produce a constant rate of interest. So this is basically your IRR or incremental borrowing rate that you use. Now, as far as depreciation is concerned, when you have to depreciate the asset, what should be the life? So here you have to check if ownership is received at end, then you will take useful life. If not received, then you will take lower of useful life and lease term. For example, if ownership is received, then no need to think, direct you will take the useful life. If ownership is not received, then you will take lower of useful life and lease term. Meaning to say, if useful life is 5 years, lease term is only 3 years, you will depreciate over 3 years. If useful life is 2 years, lease term is 3 years, then also you will depreciate it over a useful life of 2 years only, lower of the two. But if the ownership is received, then you will take the useful life. Any initial direct costs which are attributable to the activities performed by the lessee for the finance lease are included as part of amount to be recognized as an asset. Initial direct cost, for example, you have to pay stamp duty for registration, you have to pay some legal fees, some consultancy fees, anything which is attributable to the finance lease asset, you will include. The liability for a leased asset should be presented separately in the balance sheet as a current liability or a long-term liability, as the case may be. Sir, how to distinguish what is current, what is non-current? The closing balance, for example, here it is 1000. Closing balance here it is, let us say, 700. This is end of year 1, this is end of year 2. The difference between these two, that is 300, is called current liability, and the 700 will be non-current liability. For you to remember in the examination, the closing balance at the end of the next year will be the non-current portion and balance will be the current portion. So, if the closing balance is 700, 700 is non-current liability and 300 is current liability. That is what you have to distinguish. And of course, impairment is applicable, we'll understand in Accounting Standard 20. Now here, this is what I would want you to remember. I will discuss this, but you have to remember, disclosures are something, you can understand logically, but a lot of these have to be remembered, right? What are the disclosures to be made by the lessee? Asset acquired under finance lease to be segregated from assets owned. So first thing is you have to segregate assets on finance lease and other assets. Net carrying amount at the balance sheet date for each class of asset. For each class of asset on finance lease, what is the carrying amount? Reconciliation between the minimum lease payment at the balance sheet date and their present value. So basically, what is the total gross amount of minimum lease payment, at what rate have you discounted, and what is their present value? Total minimum lease payment at the balance sheet date and their present value for each of the following period. This is called analysis of lease payment. What is the analysis? How much is payable not later than 1 year, that is within 1 year period, this is the current portion. Then later than 1 year, not later than 5 years, between 1 to 5 years how much you will pay, and after 5 years what you have to pay. Now why is this disclosure given? So that the investors can understand what is the burden on this particular entity. Contingent rents recognized as expense in the statement of P&L. See, we understood, right? Contingent rents are not part of your lease payments. So you recognize that in P&L. What is the amount recognized? You have to disclose. Then total of future minimum subsequent payments expected to be received under the non-cancelable subleases at the balance sheet date. So sometimes what happens is I take an asset on lease. So say for example, I have taken an office on lease. I have made different, small offices, or I have made different small cubicles, you can say, which I will lease out to some other party, right? Now, whatever I am getting from that sublease, that I have to disclose. Description of the lessee significant leasing arrangements. What are my significant leasing arrangements? The basis on which the contingent, including but not limited to. So, description of significant leasing arrangements. What are my significant leasing arrangements? And I have to describe the basis on which the contingent rent payments are determined, existence and terms of renewal or purchase options, escalation clauses, how will the rent be increased, restriction imposed by the lease arrangement such as concerning dividends, additional debts, further leasing. So if there are any other restrictions on leases, so all of these have to be disclosed. If it is very difficult to remember, at least remember 4 to 5 points, because a couple of times they have been asked in the exams. So if you can just write these, you will get 2 to 3 marks. That is the whole idea. Okay, that is accounting in the books of the lessee. Any questions? So we have done with lessee. We will do some more questions on lessee accounting, right? But first we will complete what is the lessor's accounting. If these two aspects are handled, right, and then if sale and leaseback is handled, there is nothing else in this standard to for you to break your head on. Now, as far as in the books of lessor is concerned, when it is a finance lease, I already told you that the lessor becomes the seller and the lender, and the lessee becomes the buyer and the borrower. That is why here you can see this is a buying entry. Okay, and this becomes a liability. Same thing for the lessor. If you see, the lessor will recognize an asset under a finance lease in its balance sheet as a receivable at an amount equal to the net investment in lease. So what we'll do, we'll calculate net investment in lease. What is net investment in lease? Present value of gross investment in lease. So whatever is the present value of gross investment in lease, they would say, I have an asset which is a receivable, and you will de-recognize whatever asset you already have in the books. For example, if I have a machine which I am giving it out on lease, then what I will do, I will recognize a receivable. And I will de-recognize the asset. Okay. So gross investment in lease we have already seen. Minimum lease payments also we have already seen. Net investment is gross investment in lease minus unearned finance income or present value of the gross investment. Okay. Then if at all I am a seller, okay, so sometimes what happens is there is a manufacturer or there is a dealer, and if I am selling the asset, then the transaction of sale I'll recognize in the statement of profit and loss as per my sale policy. So sometimes what happens is, to encourage the buyers, I will give a very low discount rate. I would say your EMIs will be calculated based at 5%, market rate is 10%. Then in that case, I have to take the market rate of interest. The initial direct costs such as commission or legal fees are recognized immediately in the statement of P&L or allocated against the finance income. All of these are not really tested in the examination in depth. What we should figure out is, what is the minimum lease payment, what is the net investment, what is the unearned finance income, and how is the accounting done, right? Disclosures similar to what we have done in case of the lessee. One disclosure is the total gross investment in the lease and the present value of minimum lease payment at the balance sheet date for not greater than 1 year, 1 to 5, greater than 5. There also we did the same thing. Reconciliation, there also we did the reconciliation between the total gross investment in the lease at the balance sheet date and the present value of MLP. Then what is the unearned finance income, unguaranteed residual value, accumulated provision for uncollectible MLPs, like provision for bad debt. This is the provision for bad debt. Contingent rents recognized in the statement of P&L. So lessor also will recognize contingent rents in the P&L. Description of the significant leasing arrangement and accounting policy adopted for the initial direct cost, right? Now, what we'll do, we'll look at a same question and see how do we account it in the books of lessor. In the books of the lessor. Now here we don't have unguaranteed residual value. If there was an unguaranteed residual value, the present value would have been different. But here the present value remains the same. Accounting. Lessee account debit. This is your lease receivable. At what value? At net investment in lease, which is nothing but present value of your gross investment in lease. 2. Fixed asset account, here de-recognizing the fixed asset in the books. Then every period, like the lessee has the expense, lessor will have finance income, and then when you receive the money, bank account to lessee's account. At the end of the third year, the 17,000 is also received, so the value will become 0 and the accounts will be closed. Second question, after this we'll take up exam questions directly and then we'll come back to other questions subsequently. Kasyapa Limited has taken an asset on lease from Varuna Limited for a period of 3 years. Kasyapa is a lessee, Varuna is the lessor. Very important to identify. Okay. Annual lease rentals are 6 lakhs payable at the end of every year. The residual value guaranteed by Kasyapa, this is guaranteed residual value is 2 lakhs, whereas Varuna expects the estimated salvage value to be 5 lakhs. So what is the unguaranteed residual value? Unguaranteed residual value is 3 years. If the fair value of the asset at the lease inception is 15 lakhs and the interest rate implicit in the lease is 12%, compute the net investment in lease from the viewpoint of Varuna Limited and the unearned finance income. Present value factors is given. Now, if present value factor is given, use the same present value factor. Don't compute your own present value factors. Okay, if it is given, I have seen students, the question gives it, but because we are so used to do it on the calculator, we do it as per our present value factors. And answers will not match, you will lose marks. You may get marks if the examiner is thoughtful and if they think that even with 3 digits or 4 digits or rounding off, marks should be given. But if this is specifically given, you should not be doing extra stuff in the examination, right? Now, as far as the gross investment in lease is concerned, what is the gross investment in lease? One is the lease rentals. One is the lease rental. What is the lease rental? 6 lakhs payable at the end of every year. So, 6 lakhs into 3, 18 lakhs. That is the lease rental. Then, guaranteed residual value, 2 lakhs. Unguaranteed residual value, 3 lakhs. Total gross investment is 23 lakhs. Now, what is net investment in lease? Net investment in lease is equal to, that is a different color here, present value of gross investment in lease. So, basically, present value of 6 lakhs each year. Then, present value of 5 lakhs at end of 3 years. So, what we will do? We can do 6 lakhs into 0.8929, 6 lakhs into 0.7972, 6 lakhs into 0.7118. That is one way you can do. Or you can do the total of this, multiply with 6 lakhs. Up to you. Okay. So, this number becomes 6 lakhs multiplied by, so if I do the total of this, 0.8929 plus 0.7972 plus 0.7118. So that is 2.48442. 2.48442. If I do the total, or if I multiply this with 2.48442 multiplied by 6 lakhs, I get 1490. 0.8929, 0.79. Okay, I think I did a mistake there. I took 8792. So there is a mistake in my calculation. Just a second. 0.8929 plus 0.7972. It is 2.4019. 2.4019. If I multiply that with 6 lakhs, then it becomes 14 lakhs 41,140. I think again some rounding of difference. Just a second. 2.4019. 14 lakhs 41,140. 14 lakhs 41,080. Some rounding of difference here. But again, you will take the actual numbers and do the calculations. That is the first part. Then present value of 5 lakhs at the end of 3 years is how much? 5 lakhs into 0.7118. That is equal to, or you can split 2 lakhs and 3 lakhs also, you can do it. So that is 142 and 213. The total of all of this is 17 lakhs 96,980. This is the net investment in lease. This is the gross investment in lease. The difference between the two is your unearned finance income. So 23 lakhs minus 17 lakhs 96,000 is the unearned finance income. Okay. Now, having done this, let us look at some actual examination questions, which actually will give us more comfort. May 24, 4 marks. How to score 4 out of 4? So, our objective in all of these standards, whatever we have done so far, is how to score full marks. Target for full marks, I will guarantee you will be easily able to score 50 to 60 marks without any problem. Okay. Color Limited leased a machine to Red Limited on 1st of April 21 on the following terms. Who leased Color to Red? Color to Red means Red becomes the lessee, Color becomes the lessor. Cost of the machine 18 lakhs. Lease term 3 years. Fair market value of the machine 18 lakhs. Unguaranteed residual value 2 lakhs. Internal rate of return 12%. So rate is already given to me 12%. Cost is given 18 lakhs. Then lease term is given, fair market value is given, this is same, and residual value is 2 lakhs. The expected useful life of the machine is 5 years. It is how much? 5 years. The machine will revert to Color Limited upon the termination of the lease. So once the lease is terminated, who will get back the machine? Color will get back the machine. The lease payment is to be made at the end of each year in 3 equal parts. The present value of one due at the end of third year at 12% rate of interest is 0.7118. Present value of annuity of one due at the end of third year. It is not at the end of third year. It is for the 3 years period. For 12% is 2.4018. You are required to analyze whether the lease constitutes a finance lease and calculate the unearned finance income. Now, if any, they are smart. They have said if any. First, we have to see whether it is a finance lease. Second, we have to see if it is a finance lease, what is the unearned finance income. Now, here in this question, lease payment is not given. They have told cost, they have given residual value, lease payment is not given. Now, how do we calculate lease payment? Understand this. We are at the beginning of year 0 and we are looking at 3-year period 1, 2, 3. There is some lease payment. The lessor, think at it from the point of view of lessor. Lessor will get this lease payment. You have to bring it to the present value such that present value is 18 lakhs. Now, not only 3 lease payments, at the end of third year, 2 lakhs worth of residual value will also come back to the lessor. Sir, but no one has guaranteed it. Yes, no one has guaranteed it. But 2 lakhs worth of asset at the end of third year will come back to the lessor. So lessor has to calculate the IRR in a way such that today you are giving 18 lakhs worth of asset. You will get 3 lease payment and this is the asset which will come back. Similar to the concept of working capital which is released at the end of the capital budgeting process. You would have done that in financial management. Same logic applies here. 2 lakhs will come back. 2 lakhs will come back at the end of 3 years. So in present value term, this 2 lakhs is how much? So present value of 2 lakhs is 2 lakhs multiplied by 0.7118, 1,42,360. This is the present value of 2 lakhs. So can I say today I gave 18 lakhs. In the same value terms, I am getting back 142,360. I am getting back 142,360. I am getting back 142,360. So the net amount to be recovered from the lessee is 1657,640, which is 1657,640. I am repeating this. I gave an asset worth 18 lakhs today. In today's value terms, I will get back 142,360. So the net amount I should recover from the lessee is 1657,640. Over how many periods? 3-year period. Right? Now, this 1657,640 is my net present value without considering the lease payment. This should be equal to present value of lease payment. So present value of lease payment is how much? Lease payment into present value annuity factor. In other words, 16,57,640 should be equal to lease payment into present value annuity factor. Okay. If you are getting confused while doing this question, one more aspect or one more angle what you can use is, I'll just add one more dimension. At 12%, present value of lease payment plus present value of residual value should be equal to 18 lakhs. Another way to understand. Okay, 18 lakhs. So present value of lease payment should be equal to 18 lakhs minus present value of residual value which we calculated as 142,360. So present value of lease payment should be 18 minus 142, that is equal to 1657640. Then present value of lease payment is what? Lease payment into present value annuity factor, that is equal to 1657. So lease payment is 1657 divided by present value annuity factor. Divided by present value annuity factor, that works out to 6,90,165. This is the present, this is the lease payment. This is the lease payment. Are we clear with this calculation?
It's 11:30.
Clear? Okay.
Sir,
Yes.
in these questions, do we have to give any theory explanation?
No, see, it is what you have to decide is whether to give theory or not depends on this marks fully. Okay, what is this? 4-mark question. In 4-mark, there is so much of calculation already given. How much of theory will you explain? So, no need to give a lot of theory. Okay, but conditions checking you have to explain that yes, it has met the condition or not. That is what you have to check. But for 4 marks, I don't expect you to write saying that a lease is a finance lease if the 5 conditions are satisfied, then do the calculations and so on. Okay, so that is what you have to understand, right? Now, see, the question says analyze whether the lease is a finance lease, then calculate the unearned finance income. So very, very long question. So if you write it also, marks would be, to be frank, this question, if I was the examiner, this calculation should itself be 2.5 marks. This has to be 1 mark. This has to be 1 mark. This has to be 2 marks. So 2, 3, 4, 5, 6 marks question should be. This should be a 6 marks question. But they have asked for 4 marks. But then the way I have to think as a student is, can I get 4 out of 4? If yes, then just go ahead and do. Even if you spend 2 minutes extra, 4 marks is in your pocket. So like this, we have to reach to our target of scoring 60. Okay. Now, we have calculated this. Now, okay, to classify the lease, what do we need to check? We need to check whether it is a finance lease or not. Now, when do we check it? How do we check it is a finance lease? In the first condition itself, the present value of lease payment is 1657, which is 92% of the fair market value. Hence, it substantially covers the fair market value and it is a finance lease. No need to do this, do the second check. No need to do the second check. In fact, this is only 60%, which is actually incorrect. You can, this is as per the suggested answer, but this itself is sufficient. One condition is satisfied, it is a finance lease. Now, once it is a finance lease, the next question is, what is the unearned finance income? Unearned finance income is gross investment in lease minus your present value of lease payment and the residual value. Okay, so what is the gross investment in lease? Total lease payment plus guaranteed residual value. This is not discounted, which is 2270,495. What is the present value of lease payment and residual value? So present value of lease payment and residual value is 18 lakhs. Don't only take 1657, you have to take 142 also. Okay, so that is 18 lakhs. So unearned finance income is 470,495. This question typically comes, every time they ask a question on lease, once in 3 attempts, this question will be tested, right? This is what I was saying. Sometimes they ask disclosure requirement, you just have to list. This question was asked as an MCQ question again. Similar question was asked as an MCQ question in the recent examination. So here, a machine was given on 3 years operating lease by a dealer of the machine for equal annual lease rental to yield 30% profit margin on cost of 2,25,000. Economic life of the machine is 5 years and the output from the machine is expected to be 60, 75, 90, 120 and 105. Straight line depreciation in proportion of output is considered appropriate. You are required to compute lease rent income to be recognized in each operating year and depreciation for a 3-year lease. Okay, so here I will just do the calculation of lease rental. The remaining part once you understand operating lease, you'll be able to understand. Now, lease rent is what you have to see, 30%. 30% profit on 225,000. So, total lease rent should be 130% of 225. Total lease rent should be 130% into 225, right? So, 130% into 225 is 225 into 130%, 292, 500. 2,92,500. Okay. Then economic life of the machine is 5 years and the output from the machine is estimated to be 60, 75, 90, 120 and 105. So total output that I am expecting is how much? 60 plus 75 plus 90 plus 120 plus 105, that is 4,50,000. But I am giving it to lease. I am giving it on lease only for the first 3 years. First 3 years output is only 225. So in the first 3 years, I should recover 225. So out of the total lease rental of 290 to 500, I have to recover 50%, that is 225 out of 4,50,000. That becomes 146,250. I have to recover 146,250 over a 3-year period. So divided by 3, 48,750 is the answer. This was asked as a 2 marks MCQ in the recently concluded examination. So a lot of you are scared, right? How to handle MCQs? What the institute is doing is, from a full-fledged question, they are extracting a part and they are testing it as an MCQ. So if you are thorough in the full-fledged question, you can also handle the MCQs. This also, standalone questions. Classify operating or finance. Economic life is 10, lease term is 9. So substantial period of life is covered. So this is a finance lease. Lessee has option to purchase at lower than fair market value at the end of the lease term. So here we can assume that the lessee is likely to exercise the option, and this is also a finance lease. Lease payment should be recognized as an expense in the statement of P&L of a lessee. This happens in case of operating lease. Present value of MLP is X and fair value is Y and X is equal to Y. So they are saying present value is equal to fair value. So finance lease. Economic life is 5, lease term is 2. But the asset is of special nature and has been procured only for the use of lessee. So if it is a customized asset which cannot be used by the lessor without substantial modification, this also becomes a finance lease. Now in these type of questions, see, you should, whenever you get these type of 1 mark question, my suggestion is go ahead and attempt. You never know, 2 or 3 questions right, marks is there in your pocket. Not only here, in cash flow also they ask, classify between operating, investing, financing activities. You should do it. Whether it is a related party or not, you should do it. Any question which is in bits, 1 mark is, you should definitely do it. So this similar question we have already done. Again, this was asked for 5 marks. This just now we did again. Okay, these are more for your practice. Sale and leaseback will definitely do it. That will make you, help comfortable with the sale and leaseback transactions. Okay, so don't get scared of this chapter called leases just because it is lengthy. I know you're doing it for the first time and in CA intermediate, so you'll find it is so tough. When you come to final, there we have just not to scare you, but we have something called as Indes 116. Okay, it's a very much in-depth standard. The guidance notes and all which are published by Big Fours and all, that easily runs into 700 to 800 pages just for one standard. And leases has been one of the most important standard when you become chartered accountants in the future. So even if you are scared, don't get scared, understand the concepts and do it. Okay. So we are done with accounting for leases in the books of lessor and lessee if it is a finance lease. Now operating lease. As far as operating lease is concerned, very simple. Operating lease, you don't de-recognize asset, you do not recognize any new asset. Lessor will continue to recognize the asset and lessee will recognize the lease expenses. So simple principle here is, for operating leases, you will account for it on SLM basis. Means what? For example, lease rent is 10,000, 12,000 and 14,000. So what you will do, you will say what is the total lease? 10 plus 12, 22 plus 14, 36,000. Lease per year is 36,000 divided by 3, that is 12,000. So every year the lessee will recognize an expense of 12,000 and the lessor will recognize an income of 12,000. So first year it will be this is not lessee, some error. Okay. First year the entry will be lessee account debit in our case lessee has to pay us 10,000. So lessee account debit 10,000. Lease rent income 12,000. So 10,000 I have to receive. I am booking an income of 12,000. So I will have 2,000 debit to lease equalization. So here I have taken credit. It depends whether it is receivable or payable. So you'll have something called as lease equalization 2,000. Lessee debit 10,000. Lease rent 12,000. In year 2, what you will do? You will say lessee debit 12,000 to lease rent 12,000. In the third year, what you will do is lessee debit 14,000 to lease rent 12,000. Lease rent 12,000 means that is what is the income. So where do we get 2,000 of credit? Here we have debited 2,000, right? Here you will credit to lease equalization 2,000. Okay, so that is how you will do the accounting in the books of lessor. Same accounting in the books of lessee. What you will do? Lease rent debit, first year expense is 12,000. Lessor account payable is only 10,000. So you will say to lease equalization 2,000. Basically, I am saying this is my liability. Okay. In the second year, you will have 12,000, 12,000. In the third year, rent is 12,000. Lessor is 14,000. I have to pay 14,000. So this lease equalization here I will debit 2,000. That is how we will pass the entries. Okay. So basically, what you have to remember, it is done on SLM basis. Any difference between rent and payment, this will be taken to an account called lease equalization account. The lease equalization account can be a debit account or a debit balance or a credit balance, either of the two, right? If you don't want to pass multiple entries, you can also pass a single entry. Like for example, first year we paid 10,000. So lease rent 12,000 to bank 10,000 to lease equalization reserve 2,000. This single entry can also be passed. Okay. Now, as far as the disclosures are concerned, for lessor, they will have asset. So they will have to disclose whatever is required as per accounting standard 10. Gross carrying amount, accumulated depreciation, impairment losses, depreciation recognized, and any impairment. Then future minimum lease payment under non-cancellable operating leases, again less than 1 year, 1 to 5, more than 5. Contingent rent, description, accounting policies, similar thing. Okay, so read these disclosures together so that you remember some of these disclosures for the examination. Then in the books of lessee, total future minimum lease payment less than 5, 1 to 5, more than 5 for non-cancellable leases. Total future minimum sublease payments that you are expecting. Lease payments recognized in the P&L for the period. Sublease payments received and recognized in the P&L, and description. Okay, so that covers our part of finance lease and operating lease. Now we have another very interesting topic of discussion, which is sale and leaseback transaction. Now, what is the sale and leaseback transaction? Let us say I own a property. I own a property. I need some money against this property. One option is I can go to the bank and take a loan. Now already I have taken a loan from the bank. Why will bank give me more loan? Right? But I don't want to sell the property, or even if I want to sell the property, I want to continue to use the property. So what I will do, I will find someone like you. Now I'll tell you that I have this property. I will sell the property to you. Sell the property to you means what? You will make the payment. And you will buy the property. You are the buyer now. And I am the seller now. I have sold the property. You have bought the property. But I want to use the property. Then in that case, what you will do is, you will enter into one more arrangement with me. And you will say, okay, you will lease the property back to me. When you lease the property back to me, and if this is a part of a single transaction, it is called sale and leaseback. I have sold the property, you have leased back the property. So that is what is called sale and leaseback transaction. Okay. Now here we have to be very careful in evaluating what should be the presentation, because if I show it as if I have sold the asset and you have bought it back, I can manage the transaction. So what is the meaning of managing the transaction? For example, the property has a fair value of, let us say, 1 lakh. Property is a fair value of 1 lakh. I have sold the property to you at 2 lakhs. Fair value is 1 lakh, and because Suraj sir said, you said, okay, I will buy it at 2 lakhs. Now, do you think someone would be a fool to buy a property for 2 lakhs, which market value is only 1 lakh? No. So what they will say is, sir, I will buy for 2 lakhs, but what do? You give me, instead of market rent of 10,000, you give me a market rent of 20,000. So that is how we can do the arrangement. In this process, what happens is, fair value is 1 lakh, I have sold for 2 lakhs, I might recognize a gain of 1 lakh, correct? I will get extra money for me, and I will repay it you in terms of higher rental. So my books will show profit on sale of asset 1 lakh, more than 1 lakh actually. So what the standard says is, no, you should not be doing this. You should show the substance of the transaction. That is why sale and leaseback arrangements have different set of accounting treatment. So let us have a look at that. Sale and leaseback is a financial transaction that allows a person to lease an asset to himself. So I am leasing the asset to myself after selling it to another party. An asset previously owned by the seller lessee is sold to someone else, the lessor, at an agreed valuation and is leased back to the seller. The lessee gets cash immediately and required to make payments in the form of lease rents. Now, what you have to understand is, the accounting treatment depends on what is the kind of arrangement we have entered into. First, when sale and leaseback results in a finance lease, the excess or deficiency of sale proceeds over the carrying amount should be deferred over the lease term in proportion to the depreciation of the leased asset. So, if it is a finance lease, let us say the building that I have sold to you has a life of 30 years, I have taken it back on a non-cancelable lease for 30 years. Means what? I am controlling the asset. The asset is with me only. So, first I will say I have sold the asset. I will say debit cash, credit asset. Then you will lease it back. I will say debit asset, credit. So, what has happened? The same asset has gone out, the same asset has come back in the books. So, the standard says don't do all of this natak. Simply what you do is, if it is a finance lease, if there is a gain on sale, defer the gain on sale. If there is a loss on sale, that also you defer, because the asset is still with you. If the asset is with you, there is no point in recognizing any gain or loss immediately. So if it is a finance lease, any excess or deficiency of sale proceeds over the carrying amount should be deferred over the lease term. That is the first thing you have to remember. Second thing that you have to remember is, if the sale and lease back is at operating lease, then there are three possible scenarios. Number one, sale price is equal to fair value. Means whatever is fair value, at that price I have sold you. No problem. Profit or loss should be recognized immediately. Profit or loss should be recognized immediately. I will do a question again. You have to remember. If it is at fair value, the standard says everything is happening at fair value. Recognize the profit, recognize the loss immediately. But for finance lease, always defer. For finance lease, always defer. Then, if sale price is less than fair value, sale price is less than fair value means what? Fair value is, let us say, 1000, selling price is 800, and let us say cost for me is 700. So, what is my profit? Profit is 100. Profit is 100. Profit or loss should be recognized immediately. Profit or loss is recognized immediately. So whatever profit or loss I am making, I should recognize immediately. However, if the loss is compensated by the future lease payments at below market price, it should be deferred and amortized in proportion to the lease payment over the period for which the asset is expected to be used. Means what? If the loss is compensated, so what if I am incurring a loss, and if that loss is being compensated with lesser rentals in the future, then you should defer and amortize in proportion of lease payment. So basically what it means is, I have sold the asset to you, I have incurred a loss. Now why will I sell the asset at a loss? Why will I sell the asset at a loss? And I am selling at less than fair value. Why will I do that? So what the standard says is, you have to, if it is compensated by reduction in future lease payments, then you will defer and amortize that portion in proportion to the lease payment. Okay. Sale price is greater than fair value. The excess over the fair value should be deferred and amortized. Now, if selling price is more than fair value, no person will buy. No person will buy at a value more than fair value. So, excess over the fair value should be deferred and amortized, for which the asset is expected to be used. So, only to the extent of fair value, you can recognize the profit or loss. So, 2-3 conclusions. Finance lease, always defer. Operating lease, if the selling price is below fair value, then recognize the profit or loss immediately. But if any loss is being compensated in the future with lower, lease rentals, that you will have to defer. If selling price is more than fair value, up to fair value, whatever is the gain or loss, you will recognize. Selling price minus fair value, you will defer and amortize. Okay, so let us have a look at a question on this. Quite repeated, Jan 21, May 18, 5 bars. So keeps on coming. X sold machinery having WDV of 300 lakhs to Y Limited for 400 lakhs, and the same machinery was leased back by Y to X. The lease back is an operating lease. So if it is an operating lease, we have to check whether selling price is equal to fair value, selling price less than fair value, or fair value, selling price greater than fair value. Give your comments in the following situation. Sale price 400 lakhs is equal to fair value. So in that case, profit of 100 lakhs will be immediately recognized. If selling price is equal to fair value, profit will be immediately recognized. Okay. Fair value is 450 lakhs. So selling price is less than fair value. In that case, when the fair value is 450, the profit of 100 lakhs should be immediately recognized. There is no loss. If there is a loss, and if it is compensated by future reduction in lease payments, that is what you have to refer. Fair value is 350, sale price is 250. So here we have changed. Now it is 400, it is 250. So selling price is less than fair value even in this case. So when the fair value of leased machinery is 350, selling price is 250, loss of 50 is to be immediately recognized in its book, provided loss is not compensated by future lease payment. So what if loss is compensated? Then that loss has to be deferred. Fair value is 300, selling price is 400. If selling price is greater than fair value, the excess, what is the excess? 400 minus 300, the excess price, 100, this has to be deferred. This has to be deferred. Now what is my cost? Cost is 300, selling fair value is 300, so no profit or loss will be recognized. When fair value is 300, sales price is 400, profit of 100 lakhs is to be deferred and amortized. Fair value is 250, selling price is 290. So here what has happened is, fair value is 250, selling price is 290. So selling price minus fair value, this 40 will be deferred and amortized. Then when the fair value is 250, selling price is 290, then there are two things. One is loss of 50 lakhs which is to be recognized, and the extra component which should be deferred. So selling price minus fair value 40 you should defer. Fair value is how much? 250. WDV is how much? 300. So fair value minus WDV, this 50 of loss should be immediately recognized. So basically the trick that you have to remember is, if the selling price is more than the fair value, if the selling price is more than the fair value, you will restrict your calculations to fair value only. So fair value is how much? 250. WDV is how much? 300. We will say there is a loss. We will say there is a loss. And the difference between these two, that excess amount that you have received, will be deferred and amortized. Is this clear? Now, from examination point of view, this is definitely you have to practice multiple times, because this is a 5 out of 5 marks question. Okay. Then first one, what we did, lease calculations part, that you have to calculate, and then accounting. So step by step, if we see, for the lessee, you will take lease payment, calculate present value. Then if there is any residual value guarantee, you will calculate the present value. If there is a bargain purchase option, you will take it at present value, or if there is purchase agreement, you will calculate at present value. This is the present value of minimum lease payment, or fair value, whichever is lower, at this rate you will recognize, right? Then for the lease liability, you will make a schedule: year, opening balance, interest, payment, closing balance. Year 1, 2, 3, 4, 5, for example, opening balance, interest at the rate, payment, let us say 1 lakh, and the closing balance. So like this, you will do the calculation. Closing balance at the end of second year, whatever is the closing balance, that this portion will become non-current at the end of the first year. And the difference between these two will be the current liability. Every year you will pass interest expense, you will pass payment entry, and you will also charge depreciation, generally on straight line. If you are thorough with this calculations and the questions that we have done, also cover the questions in the study material, right? Similar questions are there is nothing complicated. Only problem you can face is, sometimes what happens is, just for example, if you get a very long question, okay, here in these type of questions, extracting the information becomes important. For example, here, took a machine on lease from XYZ. So ABC is the lessee. Fair value is 10 lakhs. Economic life of the machine is 4 years. End of each year, ABC pays 350. Very careful. End. If it is beginning, discounting will be different. The lessee has guaranteed a residual value of 50. However, XYZ estimates the residual value of the machinery will be 35,000 only. Irrelevant. What is guaranteed is what is relevant. Implicit rate is 16. Present value factors are given. You are required to calculate the value of machinery to be considered by ABC and the finance charges for the year. So here, fair value is 10 lakhs. Net present value of minimum lease payment is 10 lakhs 7,000. How did we calculate? Lease rental, present value of residual guarantee. So this one. Lower of the two, right? What is the lower of the two? Lower of the two is 10 lakhs. So lower of the two value is 10 lakhs. At that value, you will recognize the finance lease. Then what will happen? At the end of the period, this number will be different from this. That is still okay. There is not a problem, because you cannot record it at a higher value than the fair value. Okay. Then this is more like a theoretical question. So here if you see, Chief Accountant of Suraj Limited is not sure about the treatment of these lease rentals and seeks your advice. Now when they say seeks your advice, you have to also give your advice. What is the advice you will give? How to recognize whether it is operating, whether it is finance, in more of a paragraph format. Or use bullets for better scoring. This we have already considered. Okay, yeah. So we have covered all types of questions, and don't, again I'm telling you, don't get bothered about the standard, especially in the study material. A lot of content has been given. Whatever the notes we have given plus the questions we have discussed, that is enough for your preparation for the examination. Okay, so we'll not have class tomorrow and day after, that is Saturday and Sunday. What I want you to do is, for the standards that you have completed, AS2, AS10, 12, 16, 19 and 26, 6 standards, take January 25 RTP questions and solve them. Okay, once you solve them,
It's 12 o'clock.
you please put out your solution. Don't look at the answer, solve it on your own and put out the answer in the WhatsApp group. Okay, that is your homework for Saturday and Sunday for practice. Only 5 or 6 questions, whatever are there, not much. Okay, chalo, thanks a lot and have a nice day.